One company. $381 billion. Not revenue, not market value, cash, and short-term securities, sitting right now on a balance sheet in Omaha, Nebraska. That pile is larger than the entire economy of Finland. It dwarfs the GDP of Portugal. And it is not alone. Right now, the world's most powerful companies are sitting on corporate war chests so large they rival sovereign wealth funds. This is what they know that you do not. Before we look at the ranking, we need to understand what we are measuring. Cash and short-term securities refers to the liquid assets a company holds that can be converted to cash within 12 months or sooner. This includes cash and cash equivalents, money market instruments, treasury bills, and short-term investment portfolios. It does not include accounts receivable, inventory, long-term investments, or physical assets. It is not the same as net cash, which subtracts debt. It is not revenue, profit, or market capitalization. The numbers in this ranking come from TradingView data from February 2026. Some of these companies, particularly financial institutions and brokers, hold client balances and regulatory liquidity reserves within their reported figures. That means their cash may not be entirely available for strategic deployment. We will flag those cases where relevant. Now let us look at the ranking. As of February 2026, these are the world's most cash-rich companies by cash and short-term securities holdings. At number 20, SBI Holdings, Japan, $50 billion. 19, Toyota, Japan, $50.5 billion. 18, CATL, China's electric battery giant, $51.6 billion. 17, Saudi Aramco, $56 billion. 16, Alibaba, $58 billion. 15, Tencent, $59 billion. 14, Nvidia, $60.6 billion. 13, Apple, $66.9 billion. 12, PDD Holdings, $69.5 billion. 11, Volkswagen, $76.9 billion. 10, Meta, $82.4 billion. 9, Charles Schwab, $88.9 billion. 8, Microsoft, $89.5 billion. 7, Interactive Brokers, $93 billion. 6, TSMC, Taiwan, $97.8 billion. 5, Amazon, $126 billion. 4, Alphabet, $126.8 billion. 3, Daiwa Securities, Japan, $131 billion. 2, CITIC, China, $171 billion. And at number 1, Berkshire Hathaway, $381.7 billion. Berkshire Hathaway is in a category of its own. Warren Buffett's holding company sits on a cash pile that is over 2 times larger than number 2 on this list. It is not because Berkshire cannot find investments. It is because Buffett refuses to make investments that do not meet his price. This cash pile is the product of 2 things. First, insurance float. The premiums collected by Berkshire's insurance operations that sit idle until claims are paid. Second, decades of capital discipline. Selling when prices are too high, waiting when nothing looks attractive, and deploying aggressively only when valuations are compelling. As of early 2026, Buffett has been selling equity positions and allowing cash to build. That is not a sign of weakness. For Buffett, cash is optionality. Cash is the ability to buy what no one else can afford when everyone else is selling. The tech names on this list paint a different picture. Alphabet, Amazon, Microsoft, Meta, Apple, and Nvidia together hold roughly $570 billion in liquid assets. For these companies, cash is not idle. It is the fuel for the most capital-intensive investment cycle in modern business history: artificial intelligence. Amazon is building cloud infrastructure at a pace that requires tens of billions in annual capital expenditure. Microsoft is betting hundreds of billions on AI infrastructure through its Azure Cloud and OpenAI partnership. Alphabet is pouring capital into data centers, custom silicon, and AI research. NVIDIA's cash pile reflects the extraordinary margins generated by the AI chip demand cycle. Apple's cash is the reservoir behind a decade-long buyback program that has retired trillions in shares. For tech giants, cash is not caution. Cash is acceleration capital. The war for AI supremacy is being funded from corporate balance sheets. Several names on this list require a note of caution. CITIC, Daiwa Securities, Interactive Brokers, Charles Schwab, and SBI Holdings are financial companies. Their reported cash and short-term securities may include client assets held in custody, regulatory capital requirements, trading liquidity buffers, and operational reserves that are not freely available for corporate strategic use. This does not mean their numbers are wrong. It means that $1 of cash on a bank's balance sheet is structurally different from $1 of cash sitting on Apple's balance sheet. For a broker like Interactive Brokers or Charles Schwab, large liquid positions are part of the operating model, not a sign of strategic excess. When comparing corporate war chests, this distinction matters. A tech company choosing to hold $80 billion is making a strategic decision. A brokerage holding $80 billion may simply be operating its core business. Looking at the ranking by geography reveals something striking about global capital concentration. The United States dominates the top of the list. Berkshire Hathaway, Alphabet, Amazon, Microsoft, Meta, Apple, NVIDIA, Interactive Brokers, and Charles Schwab together account for over $1 trillion in liquid holdings. China is the second most represented nation, with CITIC, PDD Holdings, Alibaba, Tencent, and CATL appearing in the top 20. Japan has 3 names: Daiwa Securities, Toyota, and SBI Holdings. Taiwan has TSMC. Germany has Volkswagen. Saudi Arabia has Aramco. This geographical spread tells a story about where the world's most capital-efficient companies are headquartered, where corporate savings are concentrated, and which economies generate the kind of cash surplus that can sit on a balance sheet waiting for the right moment. Why do the world's most profitable companies hold so much cash? The reasons vary by company and context. Acquisitions. Cash-rich companies can move fast when a target is available. Microsoft used its balance sheet to buy LinkedIn, GitHub, Activision, and Nuance. Buybacks and dividends. Apple has returned over $600 billion to shareholders since 2012, mostly funded by operating cash flow. Research and development. TSMC is spending over $30 billion annually on new semiconductor manufacturing capacity. Regulatory buffers. Financial companies are required by law to hold minimum liquidity levels. Defensive positioning. In uncertain economic environments, cash provides resilience against revenue shocks. And optionality, waiting for the right acquisition, the right price, or the right market entry moment. But cash also has critics. Activist investors sometimes pressure companies to deploy idle cash rather than letting it sit. Holding cash earns minimal returns compared to reinvesting in high-margin business operations. Berkshire's massive pile has drawn occasional criticism from analysts who argue that Buffett should return more to shareholders. Apple faced similar pressure in the early 2010s before launching its buyback program. There is also an opportunity cost argument. Every dollar sitting in a treasury bill is a dollar not building the next product, buying the next competitor, or expanding into the next market. The world's most cash-rich companies are not hoarding money out of fear. Most of them are waiting for the right acquisition target, the right market dislocation, the right moment to deploy at scale. Cash is patience with resources.